Everyone's watching tech stocks. Nobody's watching the 10-year Treasury. But the two move together, and right now the 10-year is knocking on 4.7%. That single yield is the most important price in the world. It sets the cost of money for everything. So the real question isn't will stocks dip, it's who can actually bring this yield back down. Let's follow the money. The US 10-year Treasury yield is back above 4.6%, knocking on 4.7. Why does that matter? The 10-year is the benchmark that prices almost everything else, mortgages, corporate debt, and every richly valued tech stock. When it climbs, capital stops and asks a simple question: why take any risk when I can just hold the safest bond on earth and get paid? A higher yield means a lower bond price. Someone is selling the safest asset in the world. And that sell-off bleeds outward, into growth stocks, into overvalued names, into anything priced off American rates. The 10-year is gravity. When gravity gets stronger, the frothiest assets fall first. Yields this high also send a message. Buyers are scarce. Nobody wants the debt at the old price. That's not just a rate move, it's a quiet warning about confidence. When the world's safest borrower has to pay this much to find a buyer, markets start asking whether the credit is as rock solid as the label says. Start with the biggest foreign holder, Japan, sitting on roughly $1.2 trillion of treasuries, but Tokyo has its own fire. The yen just broke 163 to the dollar, a multi-decade weak point. To defend the currency, Japan has been selling treasuries, not buying, so the number one holder can't catch the falling knife without breaking itself. Probability of a Japanese rescue? 0. The second largest holder is the United Kingdom, near 900 billion, but its local governments are literally going bankrupt, no firepower left. Europe, drained by energy shocks and the war next door, its industrial base hollowed out. And the Gulf oil states, everyone expected the princes to cash in when oil spiked and the Strait of Hormuz flared. But the world's biggest crude buyer is China, and China didn't scramble for oil. The windfall never showed. America's traditional allies are out of ammo. That leaves exactly two players with the capacity to move the yield. Lever one is the Federal Reserve. The Fed isn't just a regulator, it's the single largest holder of treasuries on the planet, roughly $4 trillion worth. It can create dollars and buy the debt, expand the balance sheet, and liquidity floods back, the yield falls. Here's the catch. The Fed's leadership has been talking tighter, not looser, a bias toward shrinking the balance sheet, not growing it. So near term, don't expect a rescue. Longer term, the door to balance sheet expansion is still open if Washington chooses it. That's a variable they control, but right now, they're not pulling the lever. The second lever is China. Beijing holds $3.3 trillion in foreign exchange reserves, the largest pile on earth. If China stepped in to buy treasuries, emerging markets would likely follow the signal, and the yield would come down fast. On paper, China has the single biggest capacity to absorb supply. And here's the real puzzle. Why would Beijing do Washington a favor for free? The tech restrictions stayed on for years. The last round of tariffs hurt the US more than it hurt China. China's own trade numbers kept climbing. So any treasury purchase wouldn't be charity. It would come with a price tag: chips, market access, strategic concessions. The favor has to buy something in return. And the deepest chip in that whole game is TSMC. The Taiwan, China-based chipmaker builds the advanced processors that power Apple, Nvidia, and the entire AI stack. Washington has pushed TSMC to plant leading-edge fabs on American soil, but the most critical nodes still sit in Taiwan, China. Whoever controls that supply controls the throat of the AI economy. It's the ultimate bargaining chip in the relationship. Step back. The treasury market isn't just about interest rates. It's a live readout of who has power and who's out of options. America's allies are stretched to the limit. The only buyers with real capacity are the Fed and China, and both come with strings attached. The yield is telling you exactly where the leverage sits. So the 4.7% isn't a number to fear or cheer. It's a map. It shows a world where the old automatic buyers are gone, and the new equilibrium depends on two decisions, one in Washington, one in Beijing. Watch the debt, not just the stocks. That's where the real story is being written. So next time you see the 10-year tick higher, don't just glance at tech. Watch who's buying the debt and who can't. That's the real story behind the rate. I'm Alex. Thanks for watching.